In a world where prices are rising, your money isn't stretching as far, and everyone seems worried about the future, understanding where to put your money is key. Inflation is looming large, but here's the thing. There are ways to not just survive, but actually thrive in this environment. What if I told you that holding on to cash is one of the worst things you can do right now? Or that debt can actually work in your favor during inflation? And here's another. Would you believe that some businesses and investments not only withstand inflation, but actually profit from it? We're going to dive into some strategic approaches that might surprise you, and you don't want to miss out on our future videos. Subscribe to keep in touch as we unearth treasures of knowledge and strategies that separate the rich from the poor. Now, here are the top 10 strategies to profit from inflation that the rich keep secret. 1. Avoid holding cash. Let me ask you, have you ever left a carton of milk in the fridge for too long, only to find it spoiled when you were ready for breakfast? That's what happens to cash during inflation. It sits there, losing its value bit by bit, becoming less useful over time. Warren Buffett himself said that holding onto cash is a terrible idea during inflation because cash is trash. It might sound harsh, but it's true. Now, why is this? You may think of inflation as a sneaky thief that slowly steals the purchasing power of your money. Imagine you had $100 today and bought groceries. In a year, that same $100 might only buy you half the groceries because prices have risen. The money is still physically there, but it doesn't stretch as far. You worked hard for that money, so why let inflation chip away at it? Here's where people often get it wrong. Some believe that if they just hold on to their savings, they'll be okay, safe from the uncertainty of investing. But keeping cash is like running a marathon and choosing to sit down halfway through. It feels safe for the moment, but you're falling behind without realizing it. Inflation runs ahead, making everything more expensive while your cash stays frozen. Let me ask you another question. Would you prefer to hide your money under a mattress or put it to work, even while you sleep? When we say avoid holding cash, we're really saying you need to make your money work for you. Otherwise, it's like pouring water into a bucket with holes. You'll end up with less and less. Financial experts refer to this as real returns, which means adjusting your returns for inflation. If your money isn't growing at a rate that outpaces inflation, you're actually losing value. Here's an example. In 1970, a movie ticket cost about $1.50. Today, that same ticket is closer to $10. If someone just held on to their $1.50 for decades, thinking they could still buy that movie ticket, they'd be sorely disappointed. It's not about saving for the future, it's about saving smart. During inflation, it's critical to think about how you can convert your cash into assets that grow. Stocks, real estate, or even starting a small business are ways to stay ahead. Cash sitting in a bank account won't save you. Investing wisely will. So, instead of letting inflation quietly rob you, you can take charge. Benjamin Franklin once said, "An investment in knowledge pays the best interest." Learning how to make your money grow in real terms, beyond the clutch of inflation, is the key to financial health. The money you earn today deserves to work for you tomorrow. 2. Fixed-rate debt investments. Let's talk about debt, specifically fixed-rate debt, and why it can be your secret weapon during times of inflation. Picture this. Imagine you've locked in a deal to pay your mortgage at a fixed rate of 3%, and suddenly inflation skyrockets. Now, that same money you're paying back over time is actually worth less, which means you're essentially paying your debt with dollars that are losing value. It's like taking a loan from someone, but every year that loan becomes easier to pay off. Inflation becomes your friend here. A great example is what happened in the 1970s. Inflation rates soared, but those who had mortgages with fixed interest rates were able to pay back their loans with cheaper dollars. It's a bit like agreeing to shovel your neighbor's driveway for $10 every week, but suddenly, in a few years, the $10 doesn't buy nearly as much. The value of that agreement becomes a sweet deal for you. Now, why does this work? When you take on a fixed-rate debt, like a mortgage or student loan, you lock in a consistent, predictable payment. Inflation doesn't change that. But here's where the magic happens. As prices and wages increase with inflation, your income might rise, but your debt payments stay the same. So, in effect, you're paying back that debt with cheaper money because your future income is worth more than your past payments. Many people believe that any debt is bad debt, but that's simply not true. Ray Dalio, another giant in finance, often speaks about the importance of good debt that can work for you. Fixed-rate debt can be just that, a strategic tool in your financial toolbox when inflation hits. Take the case of Warren Buffett locking in low-interest loans to acquire assets that appreciate over time. Those assets keep gaining value, while the debt becomes easier to manage. He understood that debt, when used wisely, can be a powerful financial lever. The key takeaway here is that if you're thinking of taking out a mortgage or any other long-term loan, do it when interest rates are low and lock it in. This ensures that as inflation rises, you've secured a payment that doesn't. It's the equivalent of paying for a lifetime gym membership in today's dollars, while the cost of that membership climbs each year. In conclusion, fixed-rate debt during inflation can be a financial shield, protecting you from the erosion of your purchasing power. It's all about being smart with timing and strategy, using inflation to your advantage, not something to fear. 3. Productive assets versus unproductive assets. All right, let's dive into this. Productive assets versus unproductive assets. To get straight to the point, consider two scenarios. One where you plant a tree that grows fruit every year, and another where you buy a shiny rock that just sits in your backyard. Which one is going to give you a better return over time? That's exactly the difference between productive and unproductive assets. Productive assets are like that fruit-bearing tree, stocks, businesses, real estate. These things grow, produce income, and adapt to inflation. For example, if you own shares in a company like Apple, not only does the value of the company likely increase over time, but it also pays you dividends. Your money works for you, creating more wealth. Now, unproductive assets like gold or silver are more like that shiny rock. They just sit there. Sure, they might keep up with inflation, but they don't grow, they don't produce anything, and they certainly don't increase your purchasing power. Warren Buffett put it perfectly when he said, "For every dollar invested in gold, you're just betting it'll be shiny forever." People often think gold is a safe haven in times of crisis. And while it can hold its value, it doesn't give you the same return as something productive. Just think, would you rather own a cube of gold that doesn't change or a portion of farmland that produces food year after year? It's no contest. Productive assets win every time. Let me ask you this. If inflation rises, wouldn't you rather own a business that can raise prices to keep up with costs? That's the beauty of productive assets. They can adapt, adjust, and grow. Real estate appreciates. Businesses innovate. Stocks compound. It's all about movement and growth. And here's a practical tip: diversify. Owning a mix of productive assets like stocks, real estate, and businesses will help protect your wealth against inflation while growing it over time. Remember, it's not about betting on something just because it's shiny. It's about investing in things that will grow and give back. That's where real wealth lies. So next time you think about where to park your money, ask yourself, do I want a shiny rock or do I want a fruit-bearing tree? Choose growth. 4. Invest in capital-light businesses. Let's take a moment to think about this. You're driving down a highway. Now, would you prefer a car that barely needs fuel and cruises along effortlessly, or one that guzzles gas and needs constant stops at the pump just to keep going? That's the difference between capital-light businesses and capital-heavy ones. Capital-light businesses are the smooth ride. They don't require a ton of cash to keep running or growing. Think about companies like Microsoft or Google. Once they've built their software, it's out there being used by millions, and the company doesn't need to keep pouring money into the same product. They've done the hard work up front, and now they can focus on scaling, reaching new markets, and improving their profits without needing much extra investment. It's like planting a seed that just keeps growing with minimal watering. Compare that to a capital-heavy business, say, a construction company. Every few years, they need to replace expensive equipment like bulldozers. Even if they're making a profit, a chunk of that money has to go back into buying more bulldozers just to keep up with demand. That's exhausting, right? The profit isn't really yours to keep. It's tied up in constant reinvestment. You're always refueling. Just think about this. How does a company like Apple keep winning during inflation while others struggle? The answer lies in being capital light. Apple designs a product, and once it's out, they don't have to reinvest billions to make the same iPhone. It sells on the strength of its brand and slight innovations year after year, while Apple can keep more of the profits. That's the magic of being capital light. Warren Buffett often praises these types of businesses. In fact, one of his famous quotes is, "The best business is one that doesn't require continuous capital infusion." Why? Because that's where real wealth lies. Your money isn't getting eaten up by the cost of maintaining operations. If you're thinking of investing or starting a business, consider this. Will this business need massive amounts of cash just to stay afloat, or can I build something once and let it grow? Whether it's software, a digital platform, or a subscription-based service, the future belongs to businesses that can scale without sinking money into constant upgrades. Capital light is your ticket to steady, scalable success. 5. Businesses with pricing power. Businesses with pricing power are the ones who thrive, even when costs rise or inflation hits. You walk into a store to buy your favorite coffee, and you notice the price has gone up. But here's the catch. You still buy it. Why? Because the brand is so trusted or the product so essential that a small price increase doesn't change your mind. That's the power of pricing. In simple terms, pricing power is a company's ability to raise prices without losing customers. If a business can do this, it holds a tremendous advantage, especially in tough economic times. Think of brands like Apple, where people pay a premium for the newest iPhone every year, no matter how much it costs. Take a clothing company that makes plain white t-shirts, for instance. If they raise their prices, customers will likely jump ship to a cheaper competitor. This is what happens when a business lacks pricing power. It's not about the cheapest option, it's about the value they attach to the product. That's pricing power in action, and the clothing company is stuck in a race to the bottom, where every cent matters and the only real differentiator is cost. A business like this is highly vulnerable to inflation or rising production costs. It's all about creating something unique that people are willing to pay extra for, even when prices rise. A classic example is Starbucks. While many coffee shops sell coffee, Starbucks has crafted an experience and a brand that makes people comfortable with paying more for what feels like a little luxury. The cup of coffee is no longer just about caffeine. It's about the experience, the familiarity, and the consistency. That's how pricing power works. It's not just about a product, it's about what it represents. Warren Buffett has famously said, "The single most important decision in evaluating a business is pricing power." Why? Because a company with strong pricing power doesn't just survive inflation, it thrives. When raw materials get more expensive, when wages rise, or when shipping costs increase, businesses with pricing power can simply adjust their prices and maintain profitability. That's why you want to invest in companies with products or services that customers love enough to pay more for without flinching. In the 1970s, during a period of high inflation, companies with strong pricing power, like Coca-Cola, weathered the storm much better than those in more commoditized industries. Why? Because even though prices were going up across the board, Coca-Cola's loyal customer base kept buying no matter what. And what can you take away from this? Whether you're investing or running your own business, ask yourself, do I have something unique that people can't easily replace? The businesses that will succeed long-term are those that have built strong brands, offer superior quality, or provide something so indispensable that customers are willing to pay more for it, even when times get tough. In today's competitive market, pricing power is not just a nice-to-have, it's essential for long-term success. Always remember, it's not always about cutting costs or being the cheapest option. It's about delivering something so valuable that people are happy to pay for it, price increase or not. 6. Avoid capital-intensive businesses. When we talk about avoiding capital-intensive businesses, we're talking about steering clear of ventures that require constant reinvestment just to keep the lights on. Think of businesses like airlines or construction companies. These businesses demand a lot of upfront money to buy equipment, maintain it, and keep operations going. It's like pouring water into a leaky bucket. You're always putting more in, but it never feels full. Here's the key issue. In capital-intensive businesses, profits often don't go into your pocket. They're funneled right back into the company to buy more equipment, maintain factories, or replace aging assets. Even if you're making money, it's tied up in keeping the business alive. That's why companies like Warren Buffett's Berkshire Hathaway prefer capital-light businesses, because they don't have to continually pump money into staying operational. Now, you might ask, isn't investing in equipment or property a good thing? Well, sure, it can be if you have a clear, high-return plan. But businesses that are constantly burdened with capital costs are more vulnerable to downturns. Imagine a sudden economic dip. Companies that are constantly spending on maintenance or new capital will struggle to keep up. A better approach is focusing on businesses where the initial investment pays off over time without constant reinvestment. Software companies are a great example. Once the product is made, the costs to maintain or improve it are minimal compared to the profits it generates. That's why companies like Google or Microsoft thrive. They're capital-light but profit-heavy. So, if you want to build or invest in something sustainable, think about businesses that don't drain resources to grow. Avoiding capital-intensive businesses helps ensure that your profits work for you, not the other way around. 7. Real estate. Real estate has long been considered one of the safest and most reliable ways to build wealth, especially during periods of inflation. You know why? First, real estate tends to appreciate over time. As the cost of living rises, so do property values. This means that owning real estate gives you an asset that not only holds its value but often increases, offering protection against inflation. When prices go up, rents typically follow. If you own rental properties, you can adjust your rent to match the rising cost of living, which keeps your income in line with inflation. This is why many investors see real estate as a hedge. Your property value and rental income can both increase over time, preserving your wealth in real terms. Now, you might wonder, isn't real estate expensive and hard to get into? While real estate does require a larger initial investment, the power of leveraging can work in your favor. With a mortgage, you're using a fixed-rate loan to pay for an asset that appreciates, meaning over time, you're paying back that debt with dollars that have less purchasing power due to inflation. This is the same principle we discussed earlier with fixed-rate debt. It's like getting a discount on your loan in the long run. There's also the misconception that real estate is risky. While no investment is without risk, real estate offers tangible value. Land and property don't disappear. Plus, even in economic downturns, people still need places to live, which stabilizes demand. Practically speaking, you can start small with real estate. Look into options like renting out part of your home or investing in real estate investment trusts, which allow you to invest in real estate without directly buying properties. The key is to get in the game and let your assets grow while inflation works in your favor. 8. Commodities and physical assets. Commodities and physical assets are some of the best shields you can have when inflation hits hard. Why? Because their value tends to rise along with prices. Commodities like oil, metals, and agricultural products are the building blocks of the economy. As the cost of living goes up, so do the prices of these raw materials. Now, you might ask, what makes commodities different from other investments? Think of it this way. While the value of your dollar weakens during inflation, the value of tangible goods like gold, oil, and wheat tends to increase. People will always need fuel, food, and metals for everyday life and production. These essentials naturally rise in price when inflation spikes, making them a reliable store of value. A common misconception is that commodities are just for large investors or big businesses. But that's not true. Even average investors can get into the game through things like commodity ETFs, exchange-traded funds, which track the price of commodities, or by purchasing shares in companies that produce these materials. It's an accessible way to protect your wealth. But here's the thing, owning physical assets like gold or real estate isn't just about riding out inflation. It's about diversifying. As Ray Dalio once said, "He who lives by the crystal ball will eat shattered glass." Meaning, no one knows exactly what's coming. Having physical assets gives you a buffer against economic uncertainty. You can touch them, feel them, they're not just numbers on a screen. When the market is volatile, commodities offer stability because they represent real, essential goods. So, what practical step can you take? Consider diversifying your portfolio. Adding a mix of commodities and physical assets like precious metals, oil stocks, or even agricultural investments can help you ride the wave of inflation, ensuring your money holds its value over time. It's not about getting rich quick. It's about protecting what you've built. 9. Self-investment. Let's get real. The best investment you'll ever make isn't in stocks, real estate, or commodities. It's in yourself. In times of inflation or economic uncertainty, nothing retains value better than your skills, knowledge, and abilities. As Warren Buffett once said, the best investment you can make is in yourself. The more you learn, the more you earn. Why is this so powerful? Unlike money or assets that fluctuate in value, your skills and expertise only appreciate. Think about it, if you're a top-notch lawyer, doctor, or even mechanic, inflation can't take that away from you. You've already paid for your education in old dollars, and now you get to reap the benefits in new dollars. Your earning power adjusts with the times. Here's a question. What's one thing that stays valuable no matter the economic climate? The answer is simple, you. If you're constantly learning, improving, and adapting, you stay ahead. Whether it's taking a course to upgrade your skills, learning a new trade, or even reading books that sharpen your mind, these are investments that compound over time. Think about it this way. In a world where everything else is getting more expensive, your unique expertise becomes a rare commodity. If you're the best at what you do, people will pay for it, no matter the inflation rate. And it doesn't stop at technical skills. Emotional intelligence, leadership, and adaptability are just as valuable. Start today. Take online courses, attend seminars, network with experts in your field, and always be curious. Every new skill you learn is like adding another brick to the fortress of your financial independence. So, the next time you think about where to invest, remember, the smartest place to put your money is in you. 10. Equity in strong brands. Let's break down why investing in equity in strong brands is one of the smartest moves you can make, especially in unpredictable times like inflation. When we talk about strong brands, think about names like Apple, Nike, or Coca-Cola. These companies have built something bigger than just a product. They've built loyalty, trust, and identity. Why does that matter for you as an investor? Simple. When inflation hits, people tend to cut back on unnecessary spending, but they rarely stop buying from brands they love and trust. It's like this. When you need shoes, you're still going to buy Nike because you know what you're getting. Or when you need a phone, you'll shell out for the latest iPhone because Apple has earned that trust over decades. That's pricing power, and it keeps these companies profitable no matter what the economic climate looks like. Why do some companies crumble when times get tough, while others just keep pushing forward? The answer is brand equity. People don't just buy products, they buy a piece of the brand. Investing in a strong brand means investing in a company that knows how to navigate challenges because their customers are loyal no matter what. This is what you can do. Look at the companies you invest in. Are they known for quality, consistency, and strong customer loyalty? Brands that people are emotionally connected to can weather storms better than those that compete solely on price. Even during inflation, customers will pay for what they value. As Peter Drucker once said, the aim of marketing is to know and understand the customer so well the product fits him and sells itself. That's exactly what strong brands do. They sell themselves, and that's why you want your money tied up in them. So here we are, after exploring strategies that go beyond just surviving inflation. You now have the tools to turn this economic challenge into an opportunity. Now the question is, what are you going to do with this knowledge? How will you use it to shape your financial future? The road to thriving during inflation starts here, and now it's your move. Ready to take control? The possibilities are right in front of you.